I would like to introduce our very special guest today, Mitchell Green. Mitchell is the founder of Lead Edge Capital, a $5 billion growth stage investment firm that I believe was recently ranked #1 in private equity growth by PitchBook. Mitchell is a member of the investment committee and management committee of the firm and has personally led a number of the investments in companies such as Alibaba, Spotify, Uber, Marketo, Asana, ByteDance, and a number of other prominent names. And prior to founding Lead Edge, Mitchell was on the investment teams of Eastern Advisors, which was a Tiger hedge fund seeded by Julian Robertson, and then subsequently Bessemer Venture Partners. And besides his degrees from Wharton and Williams College, Mitchell is also a formerly nationally ranked alpine ski racer and currently serves on the board of US Ski and Snowboard Foundation and the Laguna Blanca School in Santa Barbara, California. Ladies and gentlemen, it gives me great pleasure to welcome the one and only Mitchell Green. Mitchell, thank you for joining us.
Thanks so much, Mo. Thanks for having me in.
Okay, so just before we get into investing and markets, I can't help but ask about your history as a nationally ranked alpine skier. So maybe share with us, like, how is the experience of competing nationally, or just the mere fact of gunning down a hill at 100 miles an hour shaped your worldview, or perhaps even your approach to investing or life?
Yeah, no, absolutely. So I got into ski racing because my dad was a skier, not a ski racer. And what better way to spend every Friday, Saturday, and Sunday your entire life, freezing your butt off? I grew up in Grand Rapids, Michigan. So now obviously there's not many mountains around there like Toronto. But Mount St. Anne and Marquette, Michigan, and Boyne Mountain, and then traveled all over the country and all over North America ski racing. But I think ski racing. So the guy that after I left Bessemer, I went to work I went to Wharton Business School, and then after Wharton, I worked for a hedge fund seeded by Julian at Tiger. And I asked the guy years later, why he hired me, and he said, "Well, if you can ski down the hill at 70 miles an hour, you clearly understand risk or adjusted risk and reward. Like if the stock market goes down 25%, that's when you want to buy stocks, right? And if you go down the hill at 75, 80 miles an hour, you probably aren't going to be very scared. Like that's got to be way more scary than the stock market goes down." And so, when we hire people at Lead Edge, and I'm sure we'll get into it, we want people that have had true like hardships and like really worked really hard to get something. Getting a D on a test is not like is not a hardship. Dropping the football at the Rose Bowl, or missing a field goal at the Rose Bowl, that's like truly like a failure. Or being at the Olympics and not winning, and screwing up a dive or a swim or whatever. And so we're looking for people that have faced true adversity. But I also race cars as well, and so I joke that car racing is a 45-minute ski race. It requires immense concentration. It requires immense amount, you practice for it on the weekends. And so it's just like anything. It's you get, but I believe, in car racing, we say like butt in seat. It's the same thing. It's like it's repetition. And so how we know what a good company is? Speak to like 20,000 really bad companies. And that's how you can tell what a good business is.
Yeah, so we're gonna get to good business, bad businesses, and how you think about that and your whole philosophy around it. But let me just zero in on a little bit of your upbringing. You mentioned you were in Grand Rapids, Michigan, and if I understand correctly, you came from somewhat of an operating family, an entrepreneurial family in the manufacturing arena. Is that correct?
Yeah. So my family's business was a manufacturing business that actually 100+ years ago invented the bread slicer. Unfortunately, you don't get paid per slice of bread, because if you did, I'm pretty sure I would be investing my family's own money.
So it's like literally when you say the expressions "greatest things
Yeah.
since sliced bread," you were the one who actually came up.
Yeah, well, that family invented the bread slicer. So if you go into, like, I don't know, 70,
Yeah.
80% of commercial bakeries in America, you'll see an Oliver Products bread slicer. They expanded that and all different types of things. It was a diversified
Wow.
manufacturing company. The problem is machine number 10 still runs. So, but yeah, they would sell into like Walmart and Costco and, your local bake shop and whatever.
So my guess is your family had a lot of pride in both the manufacturing side, the operating side. When you actually went and told your folks that you're going to get into private equity or venture capital, how did they react?
Yeah, I'm pretty sure my dad wouldn't have known what that was when I did it. No, so I worked at the family. I can say, so I worked at my family's company. I always wanted to work at our family business, but they had a philosophy that you basically needed to spend 5 to 10 years elsewhere
Mhm.
in order to get training. Nepotism destroys family businesses, and like being forced to hire people, like the amount of companies that get to like third, fourth, fifth generation family businesses are very small. The business that I worked for, I think was, or my dad was CEO of, was fourth generation, I think.
Hmm.
I think that's right. Might have been fifth, but I think it was fourth. And so I worked in the factory, in high school, after I was 18, and actually freshman year at Williams as well, and maybe even sophomore year. Why? Because it paid really well. I worked second and third shift. If you
Hmm.
want to know, like, if you want to know why, like I have so much respect for people that work in factories. I don't know how they do it. They do the same thing every day from like, 10 p.m. to 6 a.m. if you work third shift, or, 2 p.m. to, you know, 11 p.m. Like the same exact thing over and over and over. And that just like drove me nuts. So I actually went to Wharton Business School after working at Bessemer because I wanted to go back and work at my family's company. They actually then sold the business to a private equity firm. My dad was like, you don't want to live in Grand Rapids. You don't want to manage family politics, like people that have never worked a day in their life, people that, you want to get rid of, you can't, family members that should sell stock, but don't because they're paralyzed. And so he's just like, I'm just going to like do you a better thing. And so, yeah, so he sold it before I even had a chance.
Mhm.
If I was in the economic position that I was in today, I probably would have bid against actually, not probably, I would have bid against the private equity firms that bought it and bought it myself. The business has exploded in size. They've done a bunch of tuck-in M&A. They sold it to a private equity firm, which then sold it to a large, very, very large family called the Berwin Group, which is like a mini Berkshire Hathaway out of Philadelphia. And
Wow.
they did the things that I said they should do, but whatever.
So what advice did your old man give you when you went on your own journey?
Yeah, so when I took, so I initially got into venture growth, private equity, whatever you want to call it, joined Investment Venture Partners, and this was 2005, and I joined Bessemer. No, 2006. Sorry, I joined Bessemer. '05 was six time frame, and they handed me a computer and a telephone. And they're like, go get him, Tiger. So between, I think it was '05 to '07, I left between my now partner Brian and I, we left 20,000 voicemails, sent 15,000 emails, spoke to probably 5,000 companies. They probably put out 50 term sheets off our backs. To be clear, we were calling the companies, we got to join the meetings. We were not like pulling the trigger on deals, obviously. I
Mhm.
think they did 12 or 13 deals and probably made a $500 million plus of gains on them. They had a good deal, by the way. I think you know, we learned a ton, we got trained, but I think it cost them all of, 300 grand for a few years. But it was training, it was the training ground for learning everything. But you know how you know what a good company is? Speak to 8,000 crappy companies. Um, but so my dad instilled in me though was you're calling companies. They're not calling you. So just remember, how are you? When I took the job, my dad literally said, "Oh my God, you're one of these knuckleheads that's gonna like, pound the phones, call me back, and then they're gonna call me next quarter and the following quarter." Because my dad would get called by tons of mid-market private equity funds. He had for 20 plus years. And so he's like, you better, if you're calling people, you better figure out how to add value or you just like everyone else. So what I would end up doing is if I was calling the CEO of a company in Grand Rapids, Michigan, and then found another CEO of an interesting company in Detroit, and they were both $30 million revenue companies growing nicely, I might connect the CEOs together just to be like,
Mhm.
hey, you guys should know each other. I'm not invested in either of you. However, you might just benefit from knowing one another. Or hey, if you are an e-commerce business, and you sell, your ice.com or Wayfair or Net-a-Porter or Ukes or any of these companies, and there's all these e-commerce companies, the software companies that sell into these e-commerce businesses, and they're both growing fast. I would connect them together. Because what I
Mhm.
was trying to do is just show differentiation and be different than anybody else, calling companies. So that was probably the biggest piece of advice.
So, like, if I understand correctly, and again, I think I do from your team, that experience kind of animated the experience that you brought to Lead Edge and the initiative there, and sort of this aggressive outreach approach towards companies, targeting the companies you want. And maybe just before I go deeper on the companies you want, like, let's just speak to how you continue to add value to your portfolio companies. And I know you have a unique LP base of some 700 entrepreneurs and Fortune 500 executives from companies like Disney and Dell and Google and Microsoft and so on. Can you explain how that's reflective of your philosophy for how LPs should operate with portfolio companies and what you're looking for generally there, and how you kind of again brought that microcosm of an experience to Lead Edge today?
Sure, absolutely. I'll talk about how we leverage LPs to help. Stepping back, the three of us who run Lead Edge all started our careers cold calling companies. So my partner Brian and I were the first two cold callers at Bessemer. Bessemer had been very Shark Tank-esque. They had 5 partners. Every year, 1,000 entrepreneurs would walk in the door, and they saw what Insight was doing, and which is replicating what Summit and TA did, which is hire a bunch of 22 to 24-year-olds to pound the phones, calling companies all day long.
Hmm.
So our team now of 20, so Brian and I did it at Bessemer, our partner Nima did it at Insight. So we're one of the few people who run firms of scale that have all actually started our careers cold calling. We run a call center at Lead Edge. Like, you can't dupe us. We have very specific KPIs and OKRs around how many voicemails, how many emails that results in this week to get next week the number of calls. So we know the conversion. Our team speaks to about 8,000 companies a year, which is about 20 analysts and associates. They all used to be analysts. There's like, title inflation now everywhere in the world. And so like 0 to 2 years out of college, they pound the phones, pound the emails, and you're going to speak to 1,000 plus, 500 to 1,000 companies a year. And you're going to figure out really quickly what makes a good company and what makes a bad company. We have these very specific criteria, which I could talk about in a little bit. When you get the CEO on the phone, your goal is to sell Lead Edge. Now, how are we different than when I started the firm? I knew that the returns in this industry flowed to the top 10 firms, top 20 firms. It's like power law to the extreme.
Hmm.
Was I going to play ball with General Atlantic, TCV, Insight, Summit, Lightspeed, Sequoia, Bessemer, there's tons of them. There are great firms. There's 20, 30 firms that are like, if you've been investing in those firms since 2000, you've made a ton of money, and there's a huge amount of incumbency. Like, why is anybody gonna take money from these three knuckleheads? And I was like, well, if I had been the global head of HR at Procter and Gamble, and Brian was the global head of HR at Microsoft, and Nime was the global head of HR at Nike, we could start calling HR software companies, human resources software companies, and be like, hey, I know you went from 10 million to 20 million and everybody wants to invest in you. But if you take our money, we'll go connect you to all our friends who all run big heads of HR departments like we did. And by the way, it's a lot easier to sell down than it is to sell up, right?
Hmm.
There was only one fundamental problem. The three of us had never actually run a business. And so what we did was, well, why don't we make our LPs our competitive weapon? We will build the resources to go out and outbound and reach out to companies that aren't looking for money and have a very specific lens and strike zone of what we're looking for. But when we find them, we're going to sell our LPs. We're going to be like, if you take our capital, we will get you in front of our LPs to help you with customer intros, with partner intros, with general business advice. And oh, by the way, we start using the LP all the way at sourcing. Say there's a company in Toronto that won't call us back. Well, we'll email all of our LPs in Toronto. And those could be individuals, family offices, institutions, to say, look, does anybody know anybody on the board of this company we think it could be really interested in? Not always, but oftentimes you can find a connection in. 2, we use them as McKinsey. If we're doing diligence on a company in the software space and the biotech and pharmaceutical space. Well, we have a handful of big CEOs, like the former CEO of Pfizer, or the former CEO of Biogen, or a board member of J&J, that we could like leverage to help our to help us do diligence. It's like, hey, you know more about this sector than we're ever gonna know. And we know more about software than you. You know more about the sector. Like, give us the 5 questions you'd want to know if you were talking to the CEO. And oh, by the way, it meets a bunch of our criteria. We'd love to introduce you to the CEO because we'd love to just know what you think. So
Hmm.
now the LP becomes engaged, which, I can assure you, if you're an investor in KKR or Blackstone or Apollo, they're not calling you to ask for advice. If you're an LP, we're calling you and asking for your advice. And then post investment, or like, hey, can you help with customer intros? Toast is looking for intro to these 20 restaurants. This Chamber of Software Commerce company is looking for help expanding to the UK. So it's leveraging this like really active group of people.
And how do you manage the chicken and egg dynamic? Because like in order to get the great companies, you need the great LPs. How did you get the great LPs to begin with to demonstrate to them I have great companies? Like how
That's a
did
great guy. Yeah. So stepping back, when I raised our first fund in 2011, raised around $52 million. We raised our sixth fund in 2021. It was right around $2 billion. Effectively, if you're alive, not divorced, and not a jerk, 95% of those people are in fund 6 that were in fund 1. And so it's all been word of mouth. How did we meet the former CEO of another thing? I legitly can't tell you what I had for dinner 2 nights ago, but I can tell you almost how we've met every LP. Some of the LPs I don't know now, obviously, because it's gotten so big, and we have other people on the team managing them. But how did we meet the former CEO of Kimberly-Clark, who's new to Fund 6? Well, I met him from the former CEO of DirecTV, which is, I think, been investing with us since like Fund 3 or 4, who I met from the former president of eBay, who was the COO of Intuit, Lori, who's been an LP since Fund 2 and an operating partner here as well. And I met her from somebody named Karen Francis, who was like an automotive exec, who I met from Russ Braden, who was like a tech exec, who I met from Rick Thompson, who was a tech entrepreneur, who I met from a guy named Devesh Makan, who founded Iconic, who runs Morgan Stanley. Like, I cannot literally tell you but I have this ability in my brain to put like people we know together. So we find also, if you connect people that want to know each other that don't know each other, you like build a lot of goodwill. So we generate these people great returns. We have like 15 to 20 events a year where we get LPs together. So we involved engagement. But it all started actually before that. Like, you're like, okay, well, you raised 50 million bucks. Like, how did you raise 50 million bucks? Stepping back, when I joined the hedge fund in 2008, I made a couple of private investments. The hedge fund had a really rough 08 and ended up, I bought the investments out of the hedge fund in early 09. Now, my dad laughed at me because he's like, these things don't have profits. Like, why would I invest in them? Like, just put a little bit of money in. He put a little bit in. But then I raised the money from effectively any person I'd ever cold called in my life. I was like, you run like a big business. Maybe you want to invest in me. Remember me from Bessemer? I had connected with people. I was at Wharton Business School. If you were rich, I probably approached you. If like your name was on a building, if you were like if you were on like the board of trustees at UPenn, if you were on the board of trustees at Williams College, like started with this small group of people. I pitched anybody that would listen to me this company, Bizarre Voice. It was my first investment. The CEO, Brett Hurt, I owe my entire career to. Because without that guy, without him executing, without him taking that company public, Lead Edge Capital would not exist to this day. So I did that deal. I did a second deal. And then after that second deal, in mid to late 2010, a bunch of my LPs came and said, hey, we love what you're doing. Raise a fund. We would love to be part of it. We're sick of just doing deal by deal. And we're invested in funds, and like nothing against Silver Lake or Carlisle. They don't call us and ask for help. And I'm just like, well, I'm going to leverage you for help, because what I would do at the SPV is like, listen, you're an investor in Bizarre Voice. I'm going to send you the financials every quarter, but then I'm going to ask you for help. Hey, Bizarre Voice needs an introduction to the NFL, to P&G, to American Express, to Dell. Does anybody know anybody? And somebody would be like, well, I'm the former CFO of Dell. I see the company's doing really well. I can obviously help. Sure, I'll make an intro. And then the next quarter, they would see that they signed a deal with Dell. So they'd be like, oh, well, if you can find more stock, I should introduce you to my buddy who's an exec at EMC. And so like it all just grew through word of mouth. Does that make
Interesting.
sense?
Yeah, yeah, it makes perfect sense. And maybe just to close the loop on this, because now you could reach almost anyone in the Fortune 500. Maybe you could provide just
I
a
think that's still a little bit of a stretch.
it's a little bit of
We have a very good network. It could still be better.
it could still all right. Listen, it's I'm sure you're improving every day, but you've got just this extraordinary reach. Could you share maybe the most wacky or interesting or outlandish example of a situation where you had to either originate a company that you really needed to leverage this asset, or maybe even just to add value to a company, but something that will drive the point home. And then I'd love to shift gears to
I thought you were going to ask me a different question, which is the most ridiculous way we've met in LP.
okay, that's fine
My
too.
head of biz dev, who's not here anymore, great guy, Jason. One of our most helpful a guy that's been really helpful to us over the last like 7 years. He met on an airplane flight. They were sitting next to each other. And then the guy realized when he went to our website under network that he knew like 20 people in common. And I'm pretty sure on the plane, he was probably texting. He's like, I'm sitting next to this like, guy. He claims that like he like runs biz dev at Lead Edge, this firm called Lead Edge. And then the guy will respond back. He's like, oh, I love Lead Edge. And he probably did it again. It's like, I love Lead Edge. And literally, that is like the most random, picking people up at airports for LPs. Outlandish. We'll have LPs. We have LPs email companies, like to say, hey, I'm the former CEO of ABC company in your industry. I'm an advisor to this firm. We'd love to talk to you.
Mhm.
That works a lot. So we were chasing this company up. We didn't end up investing, but we were chasing this company up in Toronto, actually, maybe in Montreal. A software company in the biotech software space. And the CEO wouldn't respond to us. So we had the former CEO of Pfizer send him a note, just being like, hey, I'm an advisor to Lead Edge. We would love to talk to you. And then like we got on the phone with Ian, with the founder of the company. Because if you run a company that sells in the pharma space and the former CEO of Pfizer emails you, you'll probably respond to the email.
Right. Yeah, yeah, absolutely. Okay, so
How about
let's
like we've won deals in all kinds of crazy ways. Well, we showed up once with a trap, like the sweepstakes,
the big checks.
the big checks. Yeah, we showed
Yeah.
up with a check that was like 10 feet long. The
What do you
CEO's
mean?
like,
Like
what?
with an equity investment check? Like
Yeah, we set up like a 10-foot check. We're like, we want to invest in you. Here's like a check.
before before you spoke terms, before anything else. You
Yeah,
just
way before we spoke. We were a small existing investor in the company, and we wanted to lead the next round. So we showed up with like a giant check. We showed up at his office. We were going to show up on like Saturday morning at his house. Then we're like, his wife will probably kill us. So yeah,
and it worked.
it worked.
All right, fantastic. Okay, so let's get into what the right company looks like. I think Buffett often referred to the Ted Williams story, where he has like one of the best hitters in all of baseball, and he avoided anything that wasn't in his exact strike zone. So I'd love to understand what your strike zone is. I know there's this lead edge 8 framework you talk about. Could you like briefly tell us about it? Why these 8, and how did you come across them?
Yeah, so we have these 8 criteria, and to give you a sense, and I'll tell you what they are, and I'll tell you how we got there. But to give you a sense of the 8 criteria, if our team of 20 associates analysts speaks to about 8,000 companies a year, if you were going to make them have all 8 criteria, all the companies had to meet 8 criteria, 1% or 80 companies would meet all 8 criteria. That is too small of a pond to fish in
Right.
in order to do 5 to 7 deals per year.
Mhm.
So what we find is if you take 5 or more of these criteria, you get about a 10% yield for around 800 companies. And of the 800 companies that you are, of the 800 companies that you would find, you would do diligence on about 150 to 175 of them
Mhm.
in order to do, call it 5 to 7 deals a year. How do you get from 800 to 150? I don't know, the CEO is not raising capital. The founder's crazy, which can be the case. And 3, the market size is too small. And so that's kind of what the funnel looks like.
Right.
Now, today we have 8. We launched, we had 6. We actually write a quarterly letter every quarter. And if anybody ever wants to get it, just we could send you the book. It's actually like a big novel that makes a great doorstop, or in the winter, kindling when you're done reading it. But our first quarterly we ever wrote was, here are our 6 criteria. And we had them because everybody, I think, thought we were a venture capital fund. We're the furthest thing from a venture capital fund. We're taking a very targeted strike line-like approach, a Moneyball approach to find companies. Now, where did this emerge from? Bessemer. So when we were at Bessemer, we were the first 2, my partner Brian and I were the first 2 cold callers that they ever had. Put us in a room, handed us a phone, handed us a computer, and said, go get them. Every week we would pitch the partners at the firm, like our best companies of the week. The second weekend we go there and we're like, we found this great company. It's like 2 million in revenue. It's going to be the next Google. They're like, no, it's not. You have no idea what the next Google is, and we certainly don't know. Find us companies that meet like 10 million in revenue. So the next week we find a company with 12 million in revenue. I'm like, I found it. It's great. How fast is it growing? 8% a year. The finest company is growing 50% a year at the time. Okay, great. Then you find one with like 2 customers. They're like, no, we need diversified customers. And so they got up to the point where we had 5 criteria and we couldn't find any companies. They're like, perfect. Now, when you come on Mondays to the pipeline meeting, you are going to tell us the name of the company, the number of criteria, and then what it does. And don't bring us any company that meets less than 3 criteria. And they're very objective criteria. If it meets 5, you better already have the next meeting set up. But don't bring us don't bring us companies to pipeline that don't meet 3 or more criteria. 3 or more criteria is what's in the strike zone. You may get lucky and swing at something with only 1 or 2 criteria and hit the furthest home run of your life. But if you're trying to build a long time investing career or a Major League Baseball career, hitting balls out of the strike zone isn't a good way to do it.
Right.
Fast forward to today, we have 8 criteria. We had 6 when we launched. And what are they? 10 million plus in revenue, 25% year-over-year growth rate, 70+% gross margins, 4 capital efficiency. This is like our version of return on equity.
Yeah.
It's like a burn ratio. Are your revenues today equal or greater than the amount of money you've burned since inception? I.e., I get 20 million of revenue, and if you burned 80, or if you burned 16. We think it's like a kind of a physical fitness. And it just, we are backing entrepreneurs, and we want to back entrepreneurs that value the value of a dollar. This criteria is the reason our loss ratios are as low as they are. Now, we've missed giant home runs because of it. Now, we've also, not every company we invest in is capital efficient. Remember, it's 5 or more criteria.
Right.
90+% gross dollar retention. Why does that matter?
Is that like recurring revenue? Is that what you're talking about?
No, the recurring revenue is coming up. So it is that part of recurring revenue. So gross dollar retention. If you only have 80% gross dollar retention, when you're 10 million of revenue, you would lose $2 million of revenue the next year. You have to like refill the bucket, right? It's like a leaky bucket. Imagine you had 30% churn, 70% gross dollar retention. There's lots of companies that have 70% gross dollar retention. That means every year when you have 10 million of revenue, you need to get 3 million new.
Just to stand in place.
To get back to par, to where you were.
Right.
That's really not a big deal at 10 million of revenue. Where it becomes a problem is when you have 200 million of revenue. And oh, by the way, retention only gets worse. It never gets better. Like, people always like, oh, my retention is going to get better. Yeah, good luck. Obviously I'm oversimplifying, but usually it does not. When you have 200 million in revenue and you have 30% churn and 70% gross retention, that means you have to get $60 million to just get back to par. So which means your marketing expense is like through the roof. which it probably leads to high burn rates and all these things. And so like we find a 90+% gross dollar retention is what we're looking for. 95 is best in class. Now that doesn't include upsells or price increases and things like that. It's just like, hey, your customers you had last year on a gross dollar amount, how much did they spend this year before, any upsells or anything?
Mhm.
Do you have a diversified customer base? Do you have any customers over 10% of revenues? We just want to know, it's not really great when you invest in a business and lose a customer if it's 45% of revenue. The same could be said of like partners and suppliers. We don't tend to invest in companies that make things like physical things, so we don't really have suppliers, but it would be the same thing. Recurring. I love investing today, knowing what revenues are going to be in August. It's just an easier way to invest. Don't start at zero every quarter. And then are you profitable at the EBITDA line? Again, we're looking for companies that meet 5 or more criteria, which is about 800 companies a year. The great thing is I can put any smart athlete through training or smart college entrepreneur who we hire and put them through a 3-week training program. And it's very easy when it's like investigative journalism. You get the CEO on the phone, you need to talk to him, you need to get some information out of him, to share some information on the market because you got to get him to talk. You're calling him, he's not calling you.
Yeah.
And tease out. And when you pitch us on Mondays, this company is named ABC. It meets 6 criteria. That is the most important thing.
So I want to actually zero in because you said earlier that you're the most different thing from venture capital, and obviously, by mere fact, by one of your criteria, which is like profitability, you're obviously already kind of beyond the pale of venture capital, so to speak. But you're really investing in venture like businesses quite often that have those kinds of growth economics. And so again, would love to understand how you straddle these worlds. And again, I think for anybody that's listening, the vast majority of funds, sort of expect the number of venture funds, expect like total zeros and then maybe some break evens and a whole bunch of just extraordinary performers that carry the fund. And you mentioned earlier, and I just want to highlight the fact that your low ratio is like extraordinary. It's very low relative to peers. Could you explain a little, double click on how you've done that?
Sure.
And again, how you straddle this world of explosive growth potential and at the same
Yeah.
time non-venture
Yeah.
dynamics.
So let's stepping back. Now, I'll give you a snapshot of our portfolio, which I absolutely think will just help to put it in perspective.
Sure.
But stepping back, if you were to think like private equity as a continuum, you got like early stage venture capital firms on like the left, Bessemer Venture Partner, I mean they have growth fund too, but Bessemer, Benchmark, Sequoia's early stage fund, again they have growth funds as well. But those guys would make 10, 20 investments out of a fund, 6 would go to 0. They'd have like some 30 baggers and like some 1X's and some 3X's. But you
Right.
need those like giant power law returns to make like great funds. And if you have a good fund, you can have like 20X funds. It's possible. It's
Right.
pretty damn rare, but the returns can be phenomenal in this, especially among the top 5 firms. On the other side, and their risk is like they go to 0 because they go out of business. Like the company didn't work. They're like
Yeah.
trying to build the next Tesla, the next Googles, the next Facebooks of the world. On the other end of the spectrum, you have buyout funds, Silver Lakes, TPG, Thoma Bravo, Vista. They all kind of do different things and add value in different ways, but a huge amount of the slow growth businesses, that grow anywhere from 5 to probably 13% or something on average for different firms, maybe 15% at the fastest. And they generate the huge amount of their returns through leverage, right? Now their blow ups happen because they over lever the company. Vista just blew up Pluralsight and took a $2.5 billion equity bath because they over levered a business that just I don't think was that high of business quality, or they overpaid or whatever. But they typically generate their returns through leverage. We fall in the middle and generate our returns through growth of the actual business. So to give you a sense, in our portfolio, 58% of all the portfolio, and these are all as of like 12/31, 58% of the portfolio are in profitable, free cash flow, EBITDA generating businesses. The remaining 42% have 3+ years of cash runway left. They grow on average 32% a year. If I just look at funds 5 and 6, fund 6 is what we're currently investing out of. That number increases to like 40%. only 9% of our Fund 5 and Fund 6 companies are based in the Bay Area. So we'll invest in companies in Nisswa, Minnesota, which are nowhere near Minneapolis, Sarasota, Florida, Ames, Iowa, Assen, Netherlands. Like, well, literally anywhere in the world. We don't care. 73% of our companies are bootstrapped at the time of investment. And we define bootstrapped as not backed by a tier one venture fund. How do you define tier one? Have you ever been, has anybody at your firm ever been in the Midas list? Like, you know, I think if you're
Yeah.
not backed by somebody like that, that's a pretty big list too. I would even argue those firms aren't all top tier. But you know, have you raised $8 million from 60 people and you're in, you know, you're in a random town in Florida? That's a bootstrap business.
Mhm.
73% of our companies are that. 82% of our companies we own preferred stock in, meaning we're the top of the cap structure, meaning we get the money out first. If we overpaid, which happens, we can still not convert to common stock and maintain a preferred. Sometimes it's got a small dividend on it, or, you know, if we had the common, we made a zero, but because we had preferred, you know, we could, you know, we could, you know, we made a return. Valuation, everybody thinks like valuation is important. It obviously is really important. But I can go invest in, pick a company, a $20 million software company, and pay him a $2 trillion valuation. But I would just say, oh, by the way, I get 3 times my money out guaranteed.
Hmm.
In any exit, I get 3 times my money out. Like, okay, the valuation's irrelevant. I just basically negotiated a piece of debt where I get 3 times my money out, or a piece of equity, structured equity, they get 3 times my thing out. You know, we're on the board 70% of the time. That, you know, we're active investors. But again, it's this, like, we're looking for bootstrap growth companies. That doesn't mean we won't go invest in companies backed by Benchmark and Sequoia and Bessemer. We've done it. But, you know, we have this team of 20 associates and they're just calling all these companies, and what's rising to the top tend to be a lot of bootstrap businesses.
Yeah. No, I think, look, a couple of points you made there, which I just want to highlight, like the fact that you're going to places where most VCs are, or even sort of growth equity players aren't fishing. That's number one. You're doing things differently. And then at the same time, you're also an active investor in a whole bunch of big names, blue chips, that I would say have a contrarian element to it. And maybe I could like dig into that. I know that you're an investor in ByteDance, for example, which has been subject
Yeah,
to a whole bunch of controversy lately. Um, I would love for you to just maybe use that as an example of why you still believe it's a great company, despite the headwinds we're seeing perhaps in the media. But I think even more interestingly, use that as an analog for like, what does being a contrarian mean to you? And how do you actually utilize that? Because you can't just be contrarian, you also have to be right. So would love to hear your thoughts on that.
sure. So I also want to be fair. There are other firms, growth equity firms, very good firms calling companies, to be clear. Insight is a great firm and has been calling companies for years. Summit Partners has been calling companies for years. There are, you know, other earlier guys like Elephant in Boston that are younger than us and invest in slightly smaller companies than us that cold call companies. You know, Dave Wan, who runs Tidemark. I'm
Sure,
sure, I know he's got a team of
sure.
people calling companies. I would argue though, we call companies and we have a value prop that I think is different than anybody on the planet. Take our money, talk, engage with us. We'll introduce you to our LPs who run and have built some of the world's largest companies. Look on our website. We'll engage you with those types of people. Tell us who you want to meet. Like, we tried to solve what is our competitive advantage versus everyone else. That is, I think, the most important thing to remember about Lead Edge. So contrarian bets. Look, I invested in Alibaba in 2010 when everybody, you know, Jack Ma stole Alipay 2 weeks before. Go figure. I think so. We have a handful of very famous hedge fund people that are investors in our fund. Some of them are literally listed on our website. And one of them always tells me if I want to know where the market's going, ask the 20 smartest hedge fund guys I know, and then let him know where what the one or two said, and then in the 18 said. He's like, oh, I could be in the 18 too, by the way. Like, he's like, if you just do opposite the crowd time and time and time again, you will make a lot of money in the public markets. Just like being contrarian. But it's not to be contrarian. It's like groupthink gets involved.
Mhm.
I'm buying ByteDance now at 5 times earnings for a business that grows 30% a year.
Mm.
I can buy ByteDance 2 years ago, or you could do, anybody could, 2 to 3 years ago, ByteDance was a 180 to $200 billion company, and Facebook was a $300 billion company. Today, Facebook is, I don't know, 1.1, $1.2 trillion company. ByteDance you can still buy for 200 to 230, somewhere in this range. They're the same size, and one grows 3x faster than the other one, maybe 4x faster at 1/5 the price. I can buy a business for 4 or 5 times earnings. That's crazy. And these are like the information, and a lot of news reports have come out. I don't know how big the business is, so I'm not telling anybody things that they don't already know after you do research on them. This company, we wish they would shut down the United States because it is it's just irrelevant to the overall business. By the way, this company would love to have social media regulation. Social media, by the way, in the Western world is like the bane of society, to be clear. I strongly believe it needs to be regulated. By the way, you know where they regulate social media? China. You gotta have a national ID to get on board on it. It's all highly regulated content, a ton of educational content. They already have that. They could happily turn it on in the United States. US regulators don't want it. And it's because of political lobbying. You know, who doesn't want social media regulation? Facebook, Snapchat, these companies like that built around it. ByteDance is happy to do it. They do it already in China. And I do believe that over the next 5 years, something I am extremely passionate about is like teenage and kids' use of cell phones, as well as kids' use of social media. You don't need to be a rocket scientist to look at the data and be like, depression rates are going up, bullying rates are going up, suicide rates are going up, body dysmorphia is going up. It's solely because of social media.
Yeah.
And so, but like, I'm an investor in TikTok, but like, we would love to fix it. But this is going to be a really big company. It's going to take time. It's no surprise that Donald Trump now supports TikTok because he wants every millennial in America to vote for him. Like, I'd do the same thing if I was him. And yet you get Joe Biden who's saying he wants to ban TikTok, but he's on it himself. Like, this is becoming like so politicized. It's gonna go to the Supreme Court, I'm sure, and we'll see how they rule. But the best thing for me as a ByteDance shareholder would be get rid of the damn thing.
Right. Yeah, no, there's a lot to say on this. But I want to come back a little bit to what's going on in your industry and your sector specifically. And uh, you talked a little bit about some of the competitive dynamics, but really the last couple of years we've seen a lot of challenges in venture capital and growth equity space. How have you navigated this period? What pivots have you had to introduce? How have you adapted your own investing as a result?
Sure.
Again, years.
Look, don't worry. In 2020 and 2021, we had our fair share of knucklehead, stupid investments we made. Everybody did. By the way, the buyout guys did too. You're going to start to see it. All the LPs think they're isolated without doing. You don't think the buyout guys overpaid either?
Of course not.
Like all the market multiples just went up. We are setting back. Private company valuations are determined by public market valuations, right? We are basically back. If you look at Morgan Stanley does a great report every week about public company software valuations, and they look at it in like different bands of growth rates. It basically looks like this. We're back to where we were in 2019, 2018, 2017, kind of from a valuation standpoint for software companies. And that's so what we did, the thing that's kept us probably out of the most trouble, and I will 100% credit my partner Nime, which is in 2018 or 2019, when valuations were going crazy, because we truly believe that good company and good investment are two fundamentally different things.
Yeah.
We decided, hey, we don't need to do these companies at 50, 100 times ARR, annual recurring revenue. It's crazy. Let's go find the entrepreneur in Ames, Iowa that has a veterinary software business, or a company in Sarasota, Florida that makes cardiac monitoring software, or a company that makes outdoor camera systems that was bootstrapped in Salt Lake City. Let's go find these entrepreneurs. Now look, they're more blue collar, but guess what? Every company doesn't need to be a giant IPO. And now with the private equity's interest in recurring revenue software businesses, because they realize they're just like great businesses. So now every mid-market private equity firm on the planet wants to buy software. That's helped us. So it gives us the ability to sell companies to these people. And it's been a huge beneficiary. We saw that trend coming and pivoted the portfolio heavily away from that. Like our biggest investment in Fund 5 is a tax software company that had never been raised capital called SafeSend. The company is probably, 4x in size since we first invested in 20 and 21, I think it was. Had that company done a minority deal in Silicon Valley, the price probably would have been 3x the price. We just bought, control, majority control.
And so, like, when you think about the whole underwriting process, and and you obviously know of a lot of your peers that are struggling. And one of the things, by the way, I came across, which I found hysterical, is you wrote this letter called, I think, the hierarchy of a bullshit letter, which is the ways in
By the
which.
way, our next one's coming out. We're coming out with version 2.0 next quarter.
Could you maybe just even touch on that? Like, how do entrepreneurs mislead investors, and how is the industry involved, and how are you
How do
sort of?
investors mislead investors? Like that's the thing. Yeah.
Yeah,
No, just if you've got profits, you put profits in the deck. That's like then. If you got profits, if you have nothing, it's like we're the best place to work in Omaha, or Silicon Valley. And showing a slide that you think is revenue and it's actually total contract value. Oh no, we've actually called frauds, to be clear.
right.
Like legit frauds, like that. They'll be like, oh, we sell security software to these types of people. You look at the customer list and you're like, huh, that company looks like a beekeeper, their website. And how are they paying $25,000 a month for security software? We literally called a fraud, and now it's like being investigated. Like it's known that it's a fraud. I think my partner is being deposed. Why? Because he's like, we started calling customers, and we're like, there's no possible way they can be spending,
For sure.
$50,000 on this kind of stuff.
And
That's like, by the way, that's the extreme.
right.
It's just showing your returns and not showing DPI. So one of the things you had asked me in the pre-call was, what should family offices care about? When you look at private equity, look at DPI. That's all that matters. If you weren't selling in 2019, 2020, and 21, when are you ever going to sell?
Right.
And so, are showing gross returns in a deck, not net returns. Again, you're not lying. It's just like, could you be slightly more transparent? Yes.
Yeah. Yeah, absolutely. And just on your own, like when you reflect on the most instructive mistakes that you guys have made, which stand out as kind of the one that was most useful to the
Look, we don't have enough time left in the call to talk about our mistakes. I could actually have you just interview my wife. She would. We work together. She could sit here all day and talk about the mistakes we make. In Fund 1, we invested in getting the sector right really matters. And there are some sectors that are just like really hard to invest in. So, for instance, companies that sell into retail can be really challenging. Just think about it. Like they're going out of business. Amazon is eating the lunch of Sears and Kmart and all these companies. So when your end universe of customers is shrinking every year, it does not make good tailwinds for put it this way. It's a lot easier, you'd want to fly a kite in a hurricane. It'd be much better to like kite surf in a hurricane than it would be to play golf in a hurricane.
Yeah. Okay. I totally get it.
So like, point the puck where the puck is already going. So like we invested in Fund 1 in a company that sold into retail and e-commerce, and there were other issues with the company, but the sector was just so damn hard. Another interesting one is we backed a company in the social media monitoring space years ago. Management team was actually very good. And some of the management team has actually like joined other companies of ours on the management team. But they would sell to a lot of the end buyers at the company were 25-year-old kids, 26, 27-year-olds, and they wouldn't stay in the job for very long. And when they moved to the next job, when like the next person came in, they would then replace it with the next shiny object. Sometimes then the person after would come in and come back to the original product. Because it just wasn't that sticky. And so like the age of your underlying buyer at a company and how long they're in their job is actually, I think, another really important thing.
Interesting. No, those are great. And I know we probably have only time for maybe 2 or 3 more quick questions, but I did want to touch on because you've obviously been very successful, and you've been successful with finding the right companies, finding the right LPs, but you've also been very successful in sort of building the right team. Or again, from an outsider's point of view. And my only data point is I had like my first interaction with your firm was a 20-minute Zoom call with 2 team members, which was Michaela and Dominique, and both of them independently sent me these handwritten thank you cards. And I had those thank you cards sitting on my desk for weeks. Like in
By the way,
general,
it's nice that they're doing their job. That's good.
yeah.
That's good to hear.
So I just want to highlight that. And also anybody I interacted with your team, of course, they've been super intelligent, but what stood out was that they were remarkably thoughtful, responsive, and kind. And I guess that question is like, how intentional, coincidental is that? How does that align with your views on team, on culture, on philosophy, values, whatever? And how do you then select them for
Yeah.
or
So
interview people like that for the firm?
for sure. So by the way, the idea came from my wife, to be very clear. So we work in an industry that's high paid. Everybody's smart. I'm actually probably one of the dumber people in this industry. Um, and if everybody's smart, then nice guys tend to win. Like people want to bet. People want people that are like nice people. Like they're like, ah, that guy, I like that guy, I like that gal. She's nice. Like that's really kind and considerate. It isn't that freaking hard to write a thank you note. So I have a handwritten thank you note tracker. I literally get every quarter, every one of our employees that would interact with LPs or on the investment team, 50 people on it. And I know how many bottles of wine they sent, and I know how many handwritten thank you notes Scott wrote. And let me tell you, I will publicly shame them. I have no problem doing it. I don't care if you're the most second, I don't care if you're my partner's Brian or Nime, and I don't care if you're an analyst 6 months out of college here. Like, I will publicly shame you in front of the entire firm saying, why aren't you writing more thank you notes? I know you're talking to CEOs. And so we now have an entire process at Lead Edge around handwritten thank you notes, and it's expected that you do it. So that starts with interviewing. We want to hire people here who are creative, who have experienced like hardships, who are intellectually curious, who will run through walls, who are just like good people.
Yeah.
So when you people that write me a handwritten thank you note, people that so I am on the investment team, I interview every incoming full-time person. I don't ever interview every intern, although I do a bunch of it. I am the last person to do the interview. If you can get to me, you are smarter than me and can do this job. I 100% guarantee it. I ask usually one question, and then I let them ask me questions. The person who sits on the phone for half an hour asking me questions, that's the person I want to hire.
Interesting. Wow. And obviously, as you've evolved, Lead
I can put
Edge.
it, sorry to interrupt. It's
Yeah,
just
please.
treat people the way you yourself want to be treated. So we're super transparent with LPs. I'm probably an investor in 15 funds. Do you know how many do quarterly calls walking their LPs through everything? Maybe one.
Hmm.
Every quarter we walk our LPs. We'll have 250, 300 LPs join a call. We do quarterly, we do a letter. We walk you through every portfolio. Here's what the companies are doing. Here's what revenues were. Here's what profits were. Here's what's going well. Here's what's not going well. Company A, B, C, D, by fund, 1 hour calls. 2, we write a quarterly letter. We try to teach people about a different topic. 3, we do about 15 to 20 events per year in different cities, formulated by in the last 6 weeks, 8 weeks, we've had 40 people in Dallas, 50 people in Austin, 60 people in Austin, 200 in New York, 40 in DC, 50 in Santa Barbara, probably 100 in San Francisco, 60 in LA. And then, our annual meeting will have north of 300 people there. We do East Coast, West Coast. And, we'll
Wow.
have portfolio companies come and speak. We'll talk about the market. We'll bring the team there. And it's a seated seating chart. We put people next to each other that should know each other. You just treat people like you yourself would want to be treated. And, it's amazing. They help you.
Yeah. Well, first of all, we of all the cities you mentioned, realize we got to drag you out to Canada.
Sure.
So
We don't have
yeah,
that many Canada LPs. That's the issue, but we want to get more over time.
yeah, and hopefully we'll help change that over time. So I know we're coming to time here, and maybe I could just wrap up with one quick question, because you've interacted with a lot of families of affluence, a lot of family offices. Obviously, yourself came from sort of an operating entrepreneurial family. Um, any parting advice that you would have for other families and other family offices?
I mean, for families, I would tell the one thing for this is people have asked me, like I've asked tons of people, like when you like you raise kids in a wealthy environment, like how do you instill work ethic in them? I actually think it's actually very simple. Most wealthy people's kids know that they're wealthy. I think it's like well, no, look, there's people that live like hermits and don't have anything, but when you stay in nice hotels, fly first class, do other things. Kids are not stupid. They're actually, I remind people to remind themselves what they were like as a kid. And then
Mm,
but they got to see mom and dad working hard. If they're like, bust your butt off, work hard every day, and so like it's actually just like, and I've asked so many of our LPs, like how they've raised just great kids, because I know what some of their kids do and have great jobs. And it's just like the time and time of the thing that like there's different things, but like the common thing is just like people that instill like a really hard work ethic in their kids are
mhm,
people themselves that work really hard and their kids watched working really hard, mom and
mhm,
dad. I think that's by far the most. In terms of like advice for family offices, sure. If you're investing in private equity, look at DPIs. That's it. That's all that matters. Like
mm,
marks are for suckers. TVPI, if you weren't the number of funds that did not return that much money in 2019 and 2020 and 2021 is just like mind blowing.
mm.
And so, look, the next 10 years might not be as good as the last 10 years, but wouldn't you at least want to invest with the people that took advantage of the last 10 years?
Absolutely.
And so, we just believe hopes and dreams investing is for idiots.
Mm,
And, look at the actual net DPI and really dig into like, why did you not sell this thing in 2020? Like, why did you not hold on to the stock? Why didn't you distribute it to LPs? And I think that's like that's the best advice I can give.
Mitchell, that was fabulous. Really, thank you so much for
Thanks for
joining.
having me on. Appreciate it.
This was great, and I can't tell you how much we appreciate you taking time out of your busy schedule to share insights with us and being so generous with your time and your wisdom.
Sure.
And
If people
thank
are
you.
ever down in New York or Santa Barbara and ever want to come in to talk with the team, we're like open books. And the other thing we're an open book on is when you invest in Lead Edge, we want you actually to meet the people that do the actual work, like the senior associates, the VPs, principals. Like, I actually think that's a great piece of advice for institutions investing in firms. Like you want to meet the next generation of people, and a lot of firms do not give access to those people.
Yeah, no, I couldn't agree more. So thank you again, and really for
Cool.
all participants, thank you for joining us. If you haven't yet donated, please just do so at lunchwithlegends.com and join us also next conversation, June 25th. We'll sit down with Steve Kalinsky, founder and CEO of New Mountain Capital. To Mitchell and everyone else on the call, thank you again for your support and wishing you all a wonderful day.